So looking at the question, it says the financial position of Casey Limited on the 1st of the 1st, 2003 is shown in the following balance sheet. So you've got all of your assets here and all of your liabilities here at the bottom of your balance sheet. So the following transactions took place during 2003. So January, Casey Limited decided to revalue the land and buildings at €580,000 on the 1st of the 1st, 2003, which includes land now valued at €100,000. In February, on the 1st of February 2003, Casey Limited bought an adjoining business which included buildings €360,000, delivery vans €58,000, stock €25,000, and creditors €33,000. The purchase price was discharged by granting the seller 400,000 shares in Casey Limited at a premium of 20 cents per share, that should say. In March, goods previously sold by Casey Limited for €1,800, that should say, were returned. The selling price of these goods was cost plus 20%. Owing to the delay in returning these goods, a credit note was issued showing a deduction of 10% of invoice price as a restocking charge. In April, a delivery van which cost €20,000 was traded in against a new van costing €36,000. An allowance of €12,500 was made for the old van. Depreciation to date on the old van was €6,600. In May, received a bank statement on May 31st showing a direct debit of €4,800 to cover fire insurance for the year ended 31st of the 5th, 2004. In July, a payment of €720 was received from a debtor whose debt had been previously written off and who now wishes to trade with Casey Limited again. This represents 60% of the original debt, and the debtor had undertaken to pay the remainder of the debt in January 2004. December, the building's depreciation charge for the year to be 2% of book value. The depreciation charge to be calculated from date of valuation and date of purchase. The total depreciation charge on delivery vans for the year was €22,000. You are required to record on a tabular statement the effect of each of the above transactions had on the relevant asset and liabilities, and ascertain the total assets and liabilities on the 31st of the 12th, 2003. So 60 marks or 15% of the exam overall. So you'd have 27 minutes in which to do this question. So first things first, right? You want to lay out your template. So you're going to be given this template in the exam. So you want to lay it out. So you're going to lay it out as follows. So you've got the first, all the assets and liabilities, and then you've got all the months when things happened. You've got 2 December columns, and you'll know the reason why. And then you've got 31st of the 12th, the total figures. So we'll go through each month by month. You can pause the video now and write down these figures if you wish. Okay, so let's look at January first of all. So Casey Limited decided to revalue the land and buildings at €580,000 on the 1st of the 1st, 2003, which includes land now valued at €100,000. So what we have here is land and buildings 460,000. They are to be revalued to 580,000. So we need to add €120,000 onto there. Then what we need to do is cancel out the depreciation that had already been charged there. So 13,800, we want to add that back in. So the total assets there, €133,800. Now, we have our assets, 133,800. What about our liabilities? We need to have 133,800 there as well. So what we do when we revalue land and buildings is down in our finance by section of our balance sheet, so our long-term liabilities, we create a revaluation reserve, and into that we put the 133,800 there as well. So that is January complete. February then, on the 1st of the 2nd, 2003, Casey bought an adjoining business which included buildings 360,000, delivery vans 58,000, stock 25,000 and creditors 33,000. The purchase price was discharged by granting the seller 3,000 shares in KC Limited at a premium of 20 cent per share. So what we do, the 350 up into land and buildings, delivery vans 58, stock 25 and creditors 33 down here. So purchase price discharged by granting the seller 400,000 shares in KC Limited. So you want to look back at the balance sheet and make sure that the share price is €1 just before you assume it's €1. In this question, it is €1 per share, so it is €400,000 that's put in there. Then that is at 20 cent per share. So €400,000 multiplied by 20 cent is €80,000. So at this point in time, we have 513,000 liabilities, but we only have €443,000 in assets when we tot these three up. So we have 70,000 in the difference. So we're going to put that into goodwill in the assets. Goodwill is an intangible fixed asset. So it is the established reputation of a business when it is being purchased by another business. So that is February complete. So you can see an awful lot of marks going for February, and they're very easy marks. The only one that you need to really remember is goodwill. So March there, goods previously sold by KC Limited for 1,800 were returned. The selling price of these goods was cost plus 20%. Owing to the delay in returning these goods, a credit note was issued showing a deduction of 10% of invoice price as a restocking charge. Okay, so goods previously sold by KC for 1,800 were returned. Selling price was 120%, so 1,800 is 120%. So 100% cost price is €1,500. So owing to the delay in returning these goods, a credit note was issued showing a deduction of 10% of invoice price as a restocking charge. So the debtor didn't get a credit note showing minus 1,800, it was minus 1,800 without €180. Okay, so 1,620. So let's take a look at this. So the stock, as we worked out, is 100% because 1,800 is stock, or sorry, the cost price plus 20%. So it had the profit in there as well. So the stock is 1,500. So we add that back into stock because the stock has come back into the business. The debtors is reduced by the amount of the credit note. So the credit note was 1,800 minus 10% restocking charge, which is €180. So the credit note was for €1,620. So we reduce the debtors by 1,620. That leaves us with minus 120 total assets there. Now, what is the crack down with the liabilities? Well, we have minus 120 in our profit and loss. So why is that? Well, if we think about it, if the goods cost 1,500 and we sold them for 180, that would be a profit, the 20%, of €300. However, we have charged 180 as a restocking charge. So therefore, we have only really lost out on €120 profit. So the profit has been reduced by 120. So we have 120 and 120. So that is March complete. April. A delivery van which cost €20,000 was traded in against a new van costing €36,000. An allowance of 12,500 was made for the old van. Depreciation to date on the old van was 6,600. Okay, so let's think about what we're going to do here. So we'll change the delivery vans by the cost. So how was the cost affected here? Well, we minus the 20 old van and we add the 36 new van, which is 16,000 altogether. Now it's absolutely fine if you want to put minus 20 in there and then plus 36. That is absolutely fine there as well. Now we're going to add back in any depreciation on vans that had been charged. It says in the last sentence that depreciation to date on the old van was 6,600. So we add that back in because any time that we get rid of a fixed asset, we want to get rid of the depreciation that had been charged on that. Over here we see that's minus 33. So therefore, we want a plus 6600 there to reduce the amount of the depreciation. So overall there, we have assets 22,600. Now, we want to look at the bank then. Okay, so the new van cost €36,000, all right, and there was allowance of 12,500 made on that. So the difference there is 23,500 that the business would have had to pay for that van. So that is going to come out of the bank account. And as you know, the bank is down in the liabilities, so that is a bank overdraft. So therefore, that is going to increase the overdraft. So 23,500 is going to go in there. Now, we see here that I have profit and loss minus 900. So what is that? Well, obviously then it means that is a loss. So if I minus something from P&L, that is a loss. And let's see how that worked out. So I got an allowance, or the business got an allowance of 12,500, okay, on the old van. But how much was it actually worth at that point in time? Well, it was worth 20,000 minus 6,600, okay, which is 13,400. So that is a loss of 900 there. So both assets and liabilities there, 22,600 euro. So that is April completed. Next, May, we have a bank statement, and here we actually only have one expense or anything received, so that's interesting. So received a bank statement on May the 31st showing a direct debit of 4,800 to cover fire insurance for the year ended 31st of the 5th, 2004. So usually we see two items here, but we're only seeing one in this year. So we'll think about what's happened in the bank first of all. So 4,800 to pay for fire insurance. So money has come out of the bank. So therefore, we are increasing our bank overdraft there, 4,800. So where will I put that 4,800 then? So this is to cover fire insurance for the year ended 31st of the 5th, 2004. So that is for 5 months of next year. This here is 2003. We are doing 2003's year here. So that is going to be insurance prepaid. So I can see up here I already have insurance prepaid 1.5. So I'm going to put my 4,800 in there as well. Then what I'm going to do is I'm going to work out the December column. So I told you we have two December columns. One of them is for the depreciation and the other one is for the bank adjustment. So it's going to be any prepayments or amounts due or whatever at the end of the year. So what I want to do here is say how much insurance is attributable to the current year, which is 2003. So this here 4,800, right? 5 months of that is for next year. So therefore 7 months of it is for this year. So 4,800 multiplied by 7 over 12 is 2,800, okay? But what I have to do is remember that I also have this 1,500 here. So that is 4,300 altogether. So I'm going to take that 4,300 away here, and that will leave me with having 2,000 euro insurance prepaid for 5 months of next year. Now, if my insurance was 4,300 for the year, what impact would that have on my profit figure for the year? Well, hopefully you would know now that it will reduce the profit figure. So minus 4,300 here. So that is your bank adjustment done. Okay, so now we can move on to July. So a payment of €720 was received from a debtor whose debt had been previously written off and who now wishes to trade with KC Limited again. This represents 60% of the original debt, and the debtor had undertaken to pay the remainder of the debt in January 2004. Okay, so a payment of 720 was received from a debtor. So we put the 720 into the bank. We're minusing this 720 because this is 720 coming into the bank, which is reducing the bank overdraft figure. So that is 720. Now, that is 60% of the debt that the debtor had owed us. So what is the other 40% that they have promised to pay us? Well, that would be 720 divided by 60 multiplied by 40. That is 480 being added back in to the debtor account. Now, 60% we have received, 40% they've promised that they're going to pay us. We are going to put, like in question 1, we are going to put 100% into the P&L because that is going to increase our profit figure. So the 100% is 1,200 there, gone into the profit and loss. So altogether, you've got 480 assets and 480 liabilities. The last month that we have to do is December. So the building's depreciation charge for the year is to be 2% of book value. The depreciation charge to be calculated from date of valuation and date of purchase. The total depreciation charge on delivery vans for the year was €22,000. Okay, so earlier on, I hope you remembered that we had land incorporated in this new value of €580,000. So let's take a look. So the depreciation on buildings is 16,200. So we reduce the land and buildings amount by 16,200. Hopefully you'll know that depreciation is an expense and that reduces the profit figure. So minus 16,200 there as well. And then in the delivery vans, we were told straight away that the depreciation charge is €22,000 there. So minus €22,000 from the delivery vans and minus it from the profit figure there as well. So overall, minus 38,200 and minus 38,200. Okay, so how did we get the 16,200? Well, let's take a look at it. So we had the 580 here at the start of the year for the whole year. It was revalued, but we minus the land 100,000. So 480,000 by 2% by the whole year is 9,600. And then we add the depreciation from February onwards. So 360,000 by 2% by 11 over 12 as well, which is 6,600. So that in total then is 16,200. So that is how we worked out the depreciation there. So the last thing that you have to do then is your total figure. So you are totting up all of your figures going across the whole way there, and hopefully your assets and your liabilities should equal.